Good morning, everybody, and welcome to the Fred Report conference call for January 26, 2012. My heavens, almost an entire month of the year is gone already, and I feel like it was just New Year's Eve. But we're going to get right into it, and so let's talk a little bit about the stock market here, which seems to be doing, again, about what we thought it would do. It's sort of jerky and opening down and trading up, and actually I think trading really well. The key area of NYA 7900 has been breached. We breached that yesterday. Want to see two closes above that to be real certain, but that's really the last big resistance area until the highs of last year at 137 on the Spider. We're very close to that. We're trading well. One of the things we wanted to see is a breadth surge, and we're seeing that, and volume is starting to come in. One of the questions about this market has been a relative lack of volume. We would like to see, as this rally unfolds into March, which is what we believe is going to happen, an expansion of volume and breadth as people finally throw in the towel and have to get on board on this thing. When I look at most brokerage firm research, it says we're peaking now. Obviously, this rally isn't worth playing and all that sort of stuff. And in fact, I think the rally is worth playing. And I think for most of the advisors on this call, it's really hard to tell clients that we're peaking. We really don't want to be aggressive here or even be in. So I think we should stay in this market. We should look for some more rally. Key benchmarks on the downside are now 127.50 on the Spider, and then 122, and then 120. But I don't think those are going to be hit until we take out the 137 high. And even if we are making a peak here, I do not think it's going to be a Prussian helmet type peak where you rally and then go straight down. So I think we stay with this and we enjoy it. One of the questions I keep having is David Rosenberg, the old Merrill Lynch economist, which I know a lot of you still follow, has been talking about safety and income, and I'm all for safety and income, but I think the market is probably going to start moving towards income with the possibility for growth. And when I look at some of the healthcare stocks and the healthcare indices, stocks like Merck with big yields, those sorts of things look like they're going to work a little bit better to me than straight utility stocks. We should be talking to our clients, by the way, if utilities start to see some selling and other income areas of the markets go up. Clients should be prepared for that. I know it's hard to sell utilities simply because of the income, but there might be some call writing stuff we want to do. I think you just should let your clients know that since utilities were the best performing sector last year, that they probably won't be this year, and evolve a plan that you're comfortable with in the event that they start to weaken. On the bond market, obviously the Fed news was favorable yesterday for bonds. TLT is flirting with that 116 area. If we start trading much through 116 and closing through it, because we've been through there over the last few days several different times, I think TLT, which is Treasury Bond ETF, are going to have some trouble. We've been recommending preferred stocks, corporate bonds. LQD is trading extremely well still. Frankly, munis have been very good to us. We were fortunate last year to catch the muni move very early when most people were talking about municipalities around the country defaulting. And munis still look good. Obviously, if you're in California or New York, it's fairly easy to play, but there's still ways to talk to your muni desk if you're in other states. I'd still be looking to add municipal bonds on dips here. The Fed has said rates aren't going to go up a lot, which means the bond market is probably going to be stable, but I think most of your capital appreciation is going to come in corporates and is going to come in municipals. We've had a couple of questions on high yield bonds, by the way. HYG is coming out of a pattern. The main resistance on that is 92 to 93 now, and what we have advised some of our people to do is switch into PHB, which is actually now making new highs, and it's through its resistance, and it's much less volatile. So in other words, when they're down, we want to buy HYG and PHB. On a rally, sell the HYG, put those points in our pocket, and stick with PHB, which is a little bit more stable. Obviously, the yield is a little less, but most of our income clients are looking more for the stability. So that's how I would play fixed income in those areas. Gold had a nice reversal yesterday. As people on the call know, we're very, very favorably inclined towards commodities in general. We think the problem in the next few years is going to be inflation, not deflation. One of the questions we've had is if gold is underperforming silver, which that's generally bad for the market. In terms of the charts, though, silver is coming back a little bit. Gold is still basically outperforming. That's not a couple-day thing for the person that asked that question. That's something that happens over time. We'll watch that. I don't think I'd be in silver. I would rather be in IAU, which is a cheaper way to play gold than GLD myself. But silver is probably okay here. It's when everyone gets all excited about silver and you hear everyone going high-o silver away that you need to worry about silver and gold in general. The other thing I would mention on gold is we have an outstanding target of 210 on GLD, and that will be confirmed on a monthly close above 160 on GLD. We're at 167.99 and rallying, so it looks like that's going to happen. I wouldn't go out to clients and tell them 210. I would, that's a manly target, if you will. That's a big percentage. I wouldn't want to raise expectations that way, but I would keep that in the back of your mind and realize that once again, gold and some of the gold stocks could be really good investments this year. Oil. Oil is strong into the end of January, sometimes mid-February, and then it starts to perform in line. The seasonal trade on on oil basically ends on Tuesday. Resistance on USO is fairly heavy in the 40 area. We're not sure it's going to supersede that 40 area here. In terms of the energy stocks, though, there are some, and we'll talk about them in the stock selection section of the call, where you've got that theme of growth plus dividend yield. And so we still like some of the oil stocks. We're remaining overweight on oil. We're also very excited, by the way, still on healthcare and pharmaceuticals, and financials, which we moved to an equal weight, seem to be doing pretty well for us. So let's see how this thing shakes out.